Hi, everybody. My name is Shay Lappin, president of K Properties and Investments, and just want to thank you for joining today's webinar. Today, we will be specifically diving into how investors utilize debt or placing debt in their 1031 exchange within the DST properties or the Delaware Statutory Trust properties. So this should be an exciting webinar just to see the different ways that debt can be a potential use in a 1031 exchange or to fulfill a requirement that you need for your 1031 exchange. Just some housekeeping items. We always do like to disclose that we're not here to provide any direct tax or legal advice. We're here to kind of provide you education. We highly recommend having your CPA and or legal team involved in a 1031 exchange to make sure that you are replacing what is needed so that you do have a full tax deferral. We are happy to answer any questions for your CPA or team, but our goal is to, give you a high-level overview here, and then should you want to reach out to your advisor here at K Properties and or if you need an advisor, someone on our team, you can reach out to us and we will set that up. We love doing hypotheticals and overviews ahead of time to educate and make sure that this product and this investment is right for you. We will also walk you through, as you can imagine, all real estate has a level of risk. All investing has a level of risk. And so we highly recommend if you, need your capital today, you could do a partial 1031 exchange, take some chips off the table, definitely speak with your CPA to see what that tax consequence is. But we do have a lot of clients who do that for planning. They need money because, DSTs are considered to be illiquid and are a long-term investment strategy. There are DSTs with different potential hold periods that we can try to target what your goals and objectives are, but there's always, just like in any, real estate investment strategy, you could have, business plan A and have to pivot for any particular reason or have to hold something because maybe something's going on in the market and it's just not the best time to sell. Vice versa, things could sell earlier than the business plan for various reasons. The other thing to note is that anybody investing in DSTs or any entity has to be an accredited investor, and it's not a official certificate. From a high level, all the underlying investors that are taking title or the underlying investors in an entity need to have a net worth of $1 million or more minus their primary residence. If it's a entity like a trust, an LLC, a partnership, we can accreditate the underlying investors, or if you just want to accreditate the entity itself, then the entity itself has to have assets of $5 million or more inside of that entity. And it could be debt and equity in that situation. So you could have a $6 million property with $4 million debt. That would qualify. The only other item to reach out to us is if you have an irrevocable trust. There are ways to qualify an irrevocable trust, but we will need to dive in a little deeper before you go too deep into a process here. So now let's dive into just the overview. Although we're targeting debt today and how you could potentially utilize debt in your 1031 exchange, just want to do a quick overview of our firm and a quick overview of the 1031 exchange for people that might be newer to the tax code. Here at K Properties, we have specialized, Dwight K, our founder, has specialized for almost the past 2 decades, 1031 exchanges within this type of product. We've had to date over 9,000 investments go into DSTs, which is a very large number, which allows us, to be exposed to a lot. We get to, see how different deals are reacting in different economical cycles, different areas of the country, different asset classes. And obviously that knowledge doesn't guarantee anything, but it helps us walk you through the pros and the cons. More importantly, DSTs are unique in that it allows you to diversify and be 100% passive. There really are only two types of passive investments within the 1031 exchange world. And those are generally, DSTs like we're speaking of today, or a lot of people are familiar with net lease properties or triple net properties. The item to lightly discuss on triple net properties, if you're considering that, buying a triple net or a DST, triple net can be really a great tool. You might have a very strong tenant, and people, you'll hear people out there say mailbox money, you just collect the mailbox money. But it's important to understand that not all triple nets are fully passive, and actually a majority do have a level of management, whether that's from an accounting perspective or a lot of tenants will still require the landlord to be involved on repairs or paying property taxes, paying insurance, and then everything is reimbursed by the tenant once it's complete. So if you're in a triple net like that, you could, or a net lease property like that, I'm personally an investor in triple net properties, and we've gotten the phone calls from very, very large tenants that you probably are exposed to on that side, where you're getting a call at 4 a.m. because you need a snowplow out to clear the path, or there's a roof leak, or whatever it might be. And again, the tenant will likely, per the lease, cover that cost, but there is a level. Now, they're a lot less passive than your multifamily deal or whatever you might be owning now, but I just like to walk people through that so they don't get into a situation. We have had plenty of clients buy triple nets because, they want to own that asset 100%, and then they run into trouble they weren't aware of or their broker did not disclose to them. The biggest thing for a lot of investors with triple nets is just the over concentration. So, you can have a very large piece of your net worth in one triple net building, and what happens if they don't renew the lease, or what happens if they forget to pay the property taxes or insurance? Big companies will have that, and you're dealing with that headache and having to come a large amount of money out of your pocket so you don't, cause an issue for your title on your property. Or what happens if the company goes bankrupt or goes dark, meaning they're still paying the rent, but they've left the building. So you're going to have to re-tenant that location, which is a lot of work. It's a lot harder to re-tenant any commercial asset, generally speaking, compared to a single family house or a multifamily deal. And it can be very costly. You're paying a leasing broker a pretty substantial fee if you want to get access to some of these replacement tenants. You're paying for tenant improvements on these buildings, and it can work out in the long run, but it could take 12 to 24 months to get that property back stabilized. So we do buy triple nets and net lease properties within the DST structure. And a lot of the institutions that we work with also buy them for the DSTs that we offer on our platform. But when these situations happen, you're not as over concentrated. We really highly recommend the diversification so that, God forbid, if one of the 5 DSTs or one of the 8 or however much you diversify has to have a replacement tenant or, some sort of moving parts, it doesn't, wipe out your entire income stream. Because again, there's just as much risk in the DSTs on the underlying real estate as if, you or I own that piece of real estate on our own. Some of the groups we work with, are very large institutional, so there's some economies of scale potentially on situations where, you need to get your hands, quote unquote, dirty. So if you have any questions on triple nets, I personally, between myself and Dwight, we've purchased, negotiated, dealt with, all the various tenants that investors consider on the net lease side. And we've seen how they've operated, how they've, dealt with the landlord. So, you are interested in that, and you just want to get, some light thoughts on that, feel free to ask us that. DSTs may not be the right thing for you at this moment, but maybe they are in 5 to 10 years from now. And we just want to be a resource for you. And so the DSTs, utilizing them as a 1031 solution, as I mentioned, you eliminate that day-to-day or that month-by-month management. You get diversification geographically and asset class. That's a big one because, you might know your local market or the areas that you've previously invested in, But when you start getting into the net lease world or other assets out of state, your distance, you're not boots on the ground there, keeping an eye on the asset. So, with the sponsors that we work with on our platform, you get a level of that maybe you or I wouldn't be able to do on our own if we were an individual investor. And then one of the big things is the asset class or the type of tenant. There's certain tenants or asset classes within certain geographical areas that are just expensive. Real estate's expensive these days when you get into, institutional quality or higher quality. They could be 3, 5, 10, 15, 20 plus $1 million assets. And if some clients do have a larger amount where they have 5, 10, and they could look at those quality tenants, but then you have that over concentration that I was talking about. Or you might have an exchange where you're less than $3 million, and now you're looking at net lease properties that are maybe a franchisee operator or something with low lease term on it, or just maybe not in the greatest market. So you're kind of boxing yourself into, potentially higher risk assets. I'm not saying there's not one out there that you could run across, but from a high level, it's generally hard. The other thing is, as we all know, a 1031 exchange window, that 45 days to identify, it goes by fast. Having to do all of your due diligence and understanding that asset, going and seeing the asset, negotiating PSAs, ordering environmental reports, appraisals, property condition reports. At this commercial level, that some of those reports can take 2 weeks, 3 weeks to get back, and then you have an attorney reviewing it all, looking at lease abstracts, estoppels, the DSTs, the sponsors, which put together the deals that we represent on our platform. They've done all of that A to Z, and it's prepackaged, ready to go for you to look at that due diligence, third-party reports and underwriting, et cetera, and decide if that's, worth your risk profile in that particular deal. You don't need to wait weeks to get that in most cases. And then if you decided that is the best strategy or the best property for you in that DST, you can close into the DST in 3 to 5 business days. Most investors reach out to us before their 45 days, before they've closed on their relinquished property, and they start, if DSTs are right, start planning that portfolio. So the day they close and the money goes into that qualified intermediary account, that accommodator account, they are closing 3 to 5 business days later and starting their pro rata income. Sometimes these deals, if you're buying something on your own, depending on negotiations and the seller, it could take, 2, 3, 4 months to close on something. And you went 2, 3, 4 plus months with zero potential rental income. So the prepackaged nature of the DSTs for someone that is exploring those is kind of unique because the trust already owns that asset. They don't need to go out, if it's a $30 million DST, they don't need to go out and raise all the $30 million before you can close in the real estate. You can close today. I could close a week later. Someone else can close a month later until they raise that $30 million and close the offering. But everyone starts their pro rata share of income. And so when we look at a client's situation, the big item, or one of the big items in the 1031 exchange rules, is purchasing equal or greater replacement value. And so if you sold for, $3 million and you had $1 million loan on the property, that means when you sell, you're going to pay off the $1 million loan. You're only going to have $2 million that are going to move into the intermediary. So how do you get back to that $3 million equal or greater purchase price? The way you get there is you either take on another loan of $1 million+ so that you can get over that, combo equity debt of $3+ million, or you have to add in cash to the exchange, which most people don't want to just add in an extra $1 million into the exchange, although we do have people that do that just want to delever themselves. But you need to take on that loan to have a potential successful full tax deferral 1031 exchange. And so the DSTs are nice because we have a lot of DSTs that have a debt component attached. So when that sponsor was creating the DST properties, they organize the debt and prearrange the debt. And so that exists on that asset, which is really nice because we all know that if you do need debt, today's world is very difficult. You know, a lot of requirements, potential personal guarantees, or some level of recourse, or maybe you can't, as an individual borrower, get the loan to value you need because banks, you know, are trying to be more conservative, or interest rates are just high right now. So the debt coverage ratios, there's so many moving parts when you're getting a loan, and things can get screwed up in that process. We've had clients where they were buying their own property, organizing the debt. The loan broker quoted them X. And next thing you know, 45 days later, when they're getting ready to actually sign the documents, the terms changed for whatever reason. And that messes up the whole deal. And so you could really look at the DSTs and actually see the debt, see what you're getting into, and see if that's right for you. And all the debt in the DSTs are considered non-recourse financing. So you still have risk in the debt, because you could lose your equity. You know, if something happens, has to sell at a loss, or foreclosures, you know, all the same risks that debt bring to any property, but it's non-recourse, meaning they can't go after you personally. The sponsor is the one signing on the loan documents, signing the carve-outs, etc. So that's nice. So, you know, again, a review, don't need to qualify for the debt, non-recourse debt. If you decide on a DST, you can close in 3 to 5 business days. You don't have to go through this whole loan process, but you get the pass-through benefit of that debt. Traditional DSTs, most of our DSTs that have a debt component range from 30 to 50, 55% loan to values right now. You do have a couple higher loan to value DSTs that are between 70 and 90%. So if you do have a requirement to get more debt than 30 to 50%, we have tools to potentially do that. Just, you know, reach out to us and we can talk about it. And then there's DSTs that are debt free. And why we bring, I know we're talking about debt today, but why we bring up the debt free deals is, you know, if you're a conservative investor, and again, there's always risk, but if you're trying to de-risk as much as possible, the idea is not to lever up too much, right? No, don't lever up more than you necessarily have to. So some investors, they come to us with, you know, a low loan to value. And so a small chunk of money, maybe they have a $2 million property, but only $300,000 or $400,000 of debt. And so we can create a sample portfolio and cover the debt with certain DSTs, and then the other pieces of the equity we could put in a debt-free DST. So the blended is we covered what you needed, but we didn't over-lever you. Versus if you're buying something on your own, sometimes banks, they might not loan you just 10% loan to value. They might, but you know, they generally want to have slightly higher loan balances. And so it just gives you that flexibility not to over-lever, because if you over-lever, you might be comfortable with that leverage today, but you always got to look at the future, 10 years from now, 15 years from now, because if you take on debt today, you're going to need to replace that in the future. This debt is no debt is hyper amortization. So, you know, you taking on fresh debt, although there could be some tax benefits in 10 years, if your life stage at that point is not to be as ridden with debt, then you might not want to take it on now where you don't have to. And so we can kind of walk you through those different scenarios, because again, everybody's situation is different, but I just like to disclose that. You know, a few examples here. Let's say that, you know, you sell your property for $1 million and you have a $500,000 loan on it. That's, you know, a 50% loan to value. So you'll have, after you close, you have $500,000 of equity to allocate to your 1031 exchange because you paid off a loan of $500,000, and we need to now replace that. So we can look at DSTs that have 50% loan to values, put $500,000 into that DST, and now you bought $1 million worth of property. With that said, we still would highly recommend diversifying. So you don't just go into one DST with debt. You might go into 2 or 3 with that $500,000. So you know, mitigate even that debt risk, so that if something happens, you know, there's different levels of risk when you take on debt. There are obviously your catastrophic risks if something were to ever be a foreclosure or fire sale situation. The other risk is cash flow sweeps, which depending on the asset class, if it's like multifamily, there's probably some level of debt coverage ratio, or if there's like a commercial building with a net lease, there might be like cash flow sweeps related to the credit quality. So maybe if the tenant is at this credit quality and it downgrades, there's a cash flow sweep. That's why you want to be very sensitive on understanding the debt structures and not over concentrating in something, so that if there is a debt cash flow sweep, you're not, wiped out overnight. On the cash flow sweeps doesn't mean your investment's going south. It's just there to protect if you need cash to re-tenant a space and things along those lines. So, it's still technically in a lot of cases investor-owned money. You're just not receiving it in your own bank account during those cash flow sweeps. Though it's a very complex. So if you have any questions on cash flow sweep provisions, definitely reach out to us. We could walk you through that. So this is kind of just the quick visualization that I was talking about a second ago. I know we just used one DST here. Again, we recommend diversifying, but we just wanted to simplify it so you could see if you put 500 grand of equity at a 50% loan to value, you end up buying a total purchase price of $1 million. So let's say you sell your property for $1 million, you still have a 500 grand loan. Remember before I said you don't have to take on debt if you don't want to. If you're liquid, you can add in a debt-free deal. You can add in cash. So if you have 500 grand, but you need to replace $1 million, you could add in 500 grand to the exchange and be 100% equity now going forward. And again, if you're 100% equity, no refinancing risk, no cash flow super risk by the lender, no, taking on equal or greater debt in the future, balloon mortgages, cross collateralization of loans, flexibility because you don't have a loan coming due during credit crunches, recessions. You hear all the stories right now in the news. Real estate operators or individual people that have loans coming due in 2025, probably not the best time because interest rates are high when you previously had a much lower interest rate. So it's going to substantially hurt those investors on their refinance if they can't sell at an appropriate price. So this is the visual that I was talking. You had your 1031 equity, you added in cash, and that equaled, $1 million purchase price. And if anybody wants this PowerPoint, by the way, feel free to reach out to anybody on our team and we can get you this. So let's say that you sell your property and for $1 million, but you have a high loan to value, right? You had an $850,000 loan on it. Usually why loans are high like that in this situation, outside if you're just selling your building at a loss, it's because you probably refinanced capital, you tapped into that equity and stripped some money out and got some tax-free money through a loan refinance. So you might be high loan to value, but you kind of tapped into some of your profits through that refinance. But now you're selling your property, and if you don't replace that $850,000 loan that you had refinanced capital out of, you're going to get hit with a pretty decent tax consequence, most likely. Talk with your CPA, but so that's where these higher loan to values, the 70 to 90%, comes in play because you are highly leveraged. So we have these things called zero coupons. Again, it's really a play to avoid a potential high tax consequence. So, these higher loan to values typically have very little cash flow to no cash flow, but you tapped into equity somehow. That's why you're a high loan to value. So you're just kind of doing this as a tax play, blending in, so you don't have all this recapture tax, et cetera. So it's not the most ideal situation, but again, a lot of times you benefited already previous, and now you're just kind of doing a tax play. Usually these are very high quality, these zero coupon deals, high quality assets like big brand new Amazon distribution centers, big government buildings, big hospitals. But you can see here, if you put $150,000 of equity into an 85% loan to value deal, you're absorbing $850,000 of debt. I can almost guarantee, outside of a handful of investors that have access to great financing, then none of us can find a 85% loan to value offering or an investment outside of the DST world. It just is very difficult. And one of the large institutional groups we work with, they have access to this high debt because of the size they are, the bonds they float, et cetera, to make this work. But it's very rare. So when someone does have a high loan to value, I had a client, just as an example, years ago. I'll keep the numbers a little bit different so I don't disclose anything of the personal situation, but it was a very large equity piece of in the north of $50 million of their sales price. But he had done so many refinances, stripping out equity over time, that his loan to value was very high. It was something like $42 million of debt. So he was only getting like, 6 or so plus or minus of equity out of the deal once he sold that. So he had 6 or so million of equity, but his tax consequence, if he did not do a 1031 exchange, was going to be greater than the money he had, greater than 6 million, because he had such a large building that he had stripped money out that the government doesn't let you just do that tax free. So he needed to utilize the zero coupon just to avoid the massive $12-15 million tax situation. So, again, these are complex strategies that we're here to work within your box that, you and your CPA are advising of what you need to meet there. Another unique thing you can do is a zero coupon, because interest rates are really high these days, which means that cash flows are lower, right? The stuff you buy today, not that it's not a potentially good investment, it's just your debt service is higher currently because interest rates are at, mid 6s to 7%. And, you're still quality real estate still is, pricey, and cap rates aren't, in that zone where it's creating all this positive arbitrage. So some of our investors look at debt-free deals where the cash flows are potentially higher. Doesn't mean those cash flows are guaranteed, but higher because there's no debt service going on. That if they have a small amount of debt, they might put $50,000 or $75,000 into a zero coupon. Although they're getting no cash flow on that, it's covering the debt in, high institutional quality property with a, 20-year lease on it, 20-year mortgage. And then the rest of our equity is going into debt-free deals. And when you do that combo, aggregate value, you met your replacement price and you potentially maximized your cash flow versus just going in traditional debt DSTs that are at a much lower cash flow. So that might be a little confusing for some. I'm happy to draw out a situation or comparison between those. Might be helpful. So please reach out to us. If you have debt, please reach out to us. We can do these real life scenarios where you can kind of see different ways to cover that debt, blending different strategies that I spoke to. The other thing that I want to say is if you're debt free today, you might be fully depleted. So there's a lot of, talk out there when you're fully depleted, meaning you have no more depreciation because you just owned your property forever or, had a cost seg report or something where you fully depleted yourself. So if you take on debt, you're debt free today and you take on debt. So you had $1 million debt free, but you're no more depreciation. So no more potential tax shelter on that rental income. You may go, I want to take on debt. I want to put my $1 million into a 50% loan to value deal because now I bought an extra brand new $1 million, which generally creates an extra $1 million of fresh property that will have a fresh depreciation schedule. And that can substantially shelter income for a period of time. CPA will be able to calculate that out for you. And a lot of people do that, but I just want people to know, don't let the tax tail wag the dog, because you got to look long term, what I was saying. And debt might make sense, and we offer that and we do that strategy. But I just want you to know you're going from being debt free to levering up. So probably there's a balance there for people that are interested in that, not going all in levering up, but kind of doing a balance. Okay, I'll do some debt DST, some debt free. So you kind of still kept yourself at a potentially lower exposure. So feel free to go to www.kpi1031.com. On here, we have a lot of resources, past webinars. If you're registered in our site, you'll have access to our active property menu. The last announcement that I'll make is next month in April, April 23rd, we have our annual Investor Day. We expect this to be fully reserved, but we will have, approximately 10 plus major sponsors at our conference, our Investor Day. It's a great opportunity for investors to meet different sponsors, learn about their strategies. We're going to have different panels on different asset classes. It's a great educational day. It's going to be, I think, between noon and 6 p.m. It'll be at the Marriott Conference Center here in Torrance, California, Los Angeles. We have investors flying in. They can stay at the Marriott, spend time with our team, and meet the sponsors. That's important. You're investing in real estate, and, for an investor to, meet people face to face on potential, investments that they're putting a large chunk of their money is, I think, a prudent thing to do. And when we have it all in one place, a lot of these sponsors, there could be a sponsor in New York, a sponsor in Virginia, a sponsor in LA, a sponsor in Texas, and we get them all here in one spot, and you have access to looking at them. It's really a great opportunity. And so look out for that invitation. It should be going out next week, and RSVP, because we do have a max amount that can fit in the conference center. So look forward to that. Again, April 23rd, Investor Day, the annual Investor Day conference. And we'd love to see you there and meet you in person. A majority of our whole K Properties team will be there, along with many of the large top 10, top 15 sponsors in our space. So again, feel free to reach out to us. This is Shay. I'm always here as a resource for you, even if I'm not working directly on your file. I love talking with investors, and I love working with our team, and we really appreciate your time.